With recession fears swirling, announcements of big job cuts rolling out daily and retirement savings battered by a turbulent year in the markets, investors can't be faulted for feeling nervous. Rather than retreat into cash, however, now may be a good time to expand your horizons abroad, according to wealth advisors. After a decade of strong U.S. returns, see international opportunities ranging from Europe to Japan to emerging markets. When the experts were asked where they would personally deploy $10,000 outside of traditional financial markets, their ideas ranged from crowdfunding startups to exploring Colorado to investing in the increasingly valuable egg-laying power of chickens. For investors who want to use exchange-traded funds as rough proxies for the experts' ideas. In such unsettled times, it pays to make sure you're doing all you can to protect your financial future. Re-emerging markets. The idea is that emerging markets, represented by the MSCI Emerging Markets Index in US dollars, delivered a very disappointing 1.8% annualized in the 10 years ended December 2022 versus 12.5% annualized for the S&P 500. But while the past decade belonged to US stocks, emerging market stocks may be poised to outperform. The strategy is that while many emerging markets have suffered from regulatory issues, corruption, currency collapses and more, there are, encouragingly, limits to policymaker and corporate bad behavior. Securities markets remain the ultimate disciplinarians globally, especially in emerging countries. You want capital? Then you must behave. With global financial liquidity shrinking, the bond market's straitjacket on profligate emerging countries will likely result in improved fiscal and monetary prudence. This should create a propitious backdrop for inflation, rising productivity and private sector expansion stoking growth. The big picture is that the price is right as the emerging markets index trades at a 20-year low versus the US market, at less than half the price-to-book ratio, a price-to-earnings ratio that is about 60% lower, and with about twice the dividend yield. The iShares Core MSCI Emerging Markets ETF, IEMG, is one of the most popular, low-cost ways to gain exposure to emerging markets. IEMG covers about a dozen countries for a fee of 0.07%. Investors should be aware that China makes up 28% of the ETF, although that is pretty much the standard across emerging markets benchmarks. Last period's ETF performance. Since the last, Where to Invest $10,000 was published, the VanEck Pharmaceutical ETF, PPH, returned 10%, followed by Invesco Dynamic Pharmaceuticals, PJP, with a 5.8% gain and iShares US Pharmaceuticals, IHE, up 3.5%. SPDR S&P Pharmaceutic. Alternate idea. Startups may find very early-stage capital harder to raise as funding gets expensive and investors vanish. Established crowdfunding sites that vet and feature young companies looking for funding might have less competition from other funding sources. That could give the investor on these sites a better opportunity to find promising places for seed capital than in the prior easy money era. Rain or shine, entrepreneurs need capital and investors need returns. The idea is that our models suggest that this could be the best opportunity to switch out of equities and into bonds since the tech bubble of 1999-2000. Despite the S&P 500 falling almost 20% last year and the Nasdaq losing more than 30%, equity valuations are not yet cheap. The strategy is that while investor sentiment has improved in recent months as inflation and the pace of rate rises moderated, increasing hopes of a shorter and less deep slowdown for 2023, we suspect this optimism is premature. The full impact of last year's rate rises have yet to feed into the real economy, but orders continue to weaken, while there are signs of housing stress around the world. In previous cycles, these factors tended to warn of rising unemployment and steep earnings declines. Locking in close to 4% on 3-year to 5-year U.S. Treasuries looks attractive. However, if you want more risk in your portfolio, look outside the U.S. and to the low valuation of the yen and Japanese equities. Japanese banks look cheap and Japanese hotels should gain as the economy reopens to global visitors looking to take advantage of superior service at a price unimaginable a few years ago. The big picture is that we see two key dangers of getting more risk-hungry right now. First, if the Federal Reserve tightens into the slowdown, more of the financial structures that were created and thrived in the zero-interest rate era will be challenged. In 2022, this quantitative destruction undermined crypto and UK debt. In 2023, we expect the credit markets to be challenged. Secondly, when the Fed pivots, it will do so because of economic or financial stress. Following the last 12 Fed pivots, U.S. equities typically lost over 20% in absolute terms over bonds. The J.P. Morgan Beta Builders Japan ETF, BBJP, is a somewhat new ETF but has amassed $7.1 billion in assets partially due to its low 0.19% fee. It offers exposure to 277 Japanese stocks, with banks making up 6.4% of the portfolio. The ETF does not hedge the currency, though. For investors who think the dollar may go up, the Xtrackers MSCI Japan Hedged Equity ETF, DBJP, hedges out the currency and would outperform unhedged Japan ETFs, Balkunas said. It is more expensive, with a fee of 0.45%. Last period's ETF performance. The SPDR Portfolio Long-Term Treasury ETF, SPTL, and Vanguard Long-Term Treasury ETF, VGLT, were both little changed for the period. The iShares MSCI USA Quality Factor ETF, QUAL, had a total return. Head to Europe. The idea is that in recent years, US investors have done best sticking close to home. But today, investors should consider increasing their allocation to European equities. The strategy is that investors were rightly concerned about the fallout from the war in the Ukraine. Thankfully, an exceptionally mild winter has lowered the likelihood of a crippling energy shock. European equities are also benefiting from cheaper valuations, particularly in the financial sector. There are numerous reasons to be cautious on Chinese equities, but in the near term the economy is benefiting from a rapid reopening and supportive policy. For investors understandably reluctant to commit directly to China, Europe offers an alternative, and several segments of its economy, from French luxury goods to German industrials, will directly benefit from China's reopening. For international and emerging markets ETFs, look to the iShares Core MSCI Emerging Markets ETF, IEMG, iShares Core MSCI ETH, IEFA, or Vanguard Total International Stock, VXUS. For investors looking for broad exposure to Europe specifically, there's iShares Core MSCI Europe, IEUR, which covers the entire continent for a 0.09% fee. The UK, France and Switzerland are the fund's largest. Last period's ETF performance. The Schwab US Dividend Equity ETF, SCHD, had an 8.8% total return, Vanguard High Dividend Yield, VYM, and 7.7% return, and Vanguard Dividend Appreciation, VIG, returned 6.5%. The Global XS&P 500 Covered Call ETF, XYLD, an overlay shares large cap equity, OVL, had total returns of 4.4% and 3.7%. Alternate idea. Buy chickens. Why chickens? Because while inflation has become an unwelcome reality across every category of goods, few commodities have risen as fast as eggs. During the past year, the price of eggs has increased by nearly 50%, the most of any grocery category. Even relative to other necessities, the rise in egg prices has been extreme. For example, energy, which at one point threatened to push the global economy into recession, is heading down. Oil and natural gas prices are both lower than a year ago. And while the rise in egg prices has been exacerbated by a particularly bad outbreak of avian flu, surging agricultural commodity prices are an important reminder of an immutable law of economics: everyone needs to eat. International diversification. The idea is that internationally diversified portfolios are poised to benefit from favorable valuations in a falling US dollar. Capital market assumptions around Wall Street are largely in consensus that international markets are forecast to outperform the US over the next 10 to 15 years. The strategy is that the US dollar peaked in September 2022 after surging to levels not experienced since the early 2000s and 1980s. After the dollar peaked in February 1985 and September 2001, international markets outperformed the US for 4 consecutive years, 1985 to 1988, and 6 consecutive years, 2002 to 2007, respectively. The US dollar may well be headed toward normalization as the Fed is expected to wind down its tightening cycle in 2023. An improvement in growth expectations abroad would serve as an additional headwind to the dollar. A falling dollar benefits US investors allocating capital abroad. Earnings in foreign markets are converted to a weaker US dollar, boosting returns. The big picture is that there is still significant uncertainty weighing on international markets, particularly the Russia-Ukraine war and accompanying European energy crisis, and China's reversal of its long-standing zero-COVID policy. In light of these risks, valuations for the MSCI ETH index have fallen to 16% below the index's 10-year average, with a forward price earnings multiple of 12.1 as of December 31st. iShares Core MSCI ETH ETF, IEFA, as a way to get broad and cheap exposure to international developed market stocks. The ETF covers over a dozen countries with the heaviest weightings in Japan, the UK and France, and the fee is 0.07%. For investors who want emerging markets as part of their international exposure, the Vanguard Total International Stock ETF, VXUS, would also work well. It has all the ETH exposure but adds in China, Taiwan and other emerging markets countries, and charges 0.07%. Last period's ETF performance. Since September, the global S&P 500 Quality Dividend ETF, QDIV, has posted a total return of 8.8%, Alps O-Shares US Quality Dividend, OUSA, 6.6%, WisdomTree US Quality Dividend Growth, DGRW, 7.6% and Invesco S&P 500 High Dividend Low Volatility. Thank you so much for watching this video, and we thank you again for being a part of our community channel. We appreciate your continued support and look forward to serving you with more exciting videos in the future. We hope it has been helpful in understanding the world of passive income and affiliate marketing. Don't forget to hit that subscribe button, like and comment below and turn on your notifications so you never miss a video from Passive Income Journey 777.